3 beginner strategies that you can take away with you after watching this video. And if you like this video, please don't forget to like and subscribe if you're not already a subscriber. First beginner strategy is what's known as a covered call. Now, a covered call is one where you buy the stock or the index, so you own the stock, like owning a house, and then you sell a call option. And this allows you to earn a premium, like earning rent once you've actually purchased the stock. Now, what happens is that it will generate income, but you will be capping your upside. So that is that it could be that, you may have basically placed a strike price on a call option that you've sold at 10% higher than where it is right now. So in that case, if the price of the stock that you hold or the index that you hold goes up above that particular strike price, then you could be called. In other words, you could have to get rid of your stock and send that to the purchaser. Now remember that it's important to hold the same number of shares of the stock or the index as you have in the contract. So usually a contract is 100 shares, so you'd want to have 100 shares of the company in question. This could be Coca-Cola, this could be the Spider SPY index, you name it. And this is great for generating passive income on stocks you already own. Now, looking at the covered call payoff at expiration, so we have the yellow dotted line that's basically going up along here, which is just showing if we were long on that stock, so if we own the stock. So let's say that the stock price is 100 right now, that's the initial stock price, 100. So we're not going to make anything, 0, if it stays at 100. Obviously, we lose as the stock price starts to fall. If it falls to 80, that's 20% of the actual original price of the stock. We're losing 20%, going down from 100 to 80. But of course, we keep winning as the stock that we own goes up in value over time. Now, when we are shorting the call, we're getting this premium, this gap here. This is the premium that we earn as a rent. And of course, by doing this, we are going to earn, but then once the actual price of the stock goes above the strike price, here the strike price could be this point here, let's say 105. In that case, we could have someone executing or exercising their call option, and we have the obligation to give them the stock. At that point, if we were short the call, we would have to purchase the stock at that particular price. So we're losing and losing and losing. There's an unlimited loss here if we were just selling a call, but if we didn't actually own the underlying stock, because we'd make this little bit of income here, this profit here, all the way up to this point. And once the price, if the strike price is 105, let's say, once we're above this, our premium that we've earned is gradually getting eroded to 0. And then after that, we're basically negative territory. This is an unlimited loss potential. However, what we're doing here is recovering this by owning the stock. So we owned it, and as a result, it's a little difference. So being long on the stock, we're going all the way up. But with the covered call, we've earned this little gap here on top of the actual stock. So we've earned this, even if it falls, it's not so bad, right? We've actually got this little red line here is higher. So our loss is not quite as bad as it would be if we hadn't shorted the call, if we hadn't earned that premium. But then once the strike price rises above 105, let's say, at that point, we're out. So we're capping our upside risk. So we can get a little bit more on the upside, but then that's it. Okay, so rather than losing, like shorting a call that was naked, here we're having the actual, we own the stock, we own the index, and so we just get rid of it. And so we've profited from 100 to 105. We've also profited the premium we've earned from selling the call option. So that is our profit up here, and it's limited. But at least we have that. It's not too bad. Okay, nerd alert, but let me give you the shortcut that I wish I had. Would have got me there way faster. If you want to go deeper, I put together the Personal Finance Power Pack. It's a toolkit, budgeting templates, debt strategies, investing walkthroughs, all the stuff I wish I had when I was starting out. You'll find the link below, and it'll help you build a system that actually works. That was the plug. Now let's plug straight back into the content. So a second beginner strategy that you can use is what's known as a protective put. Now, a protective put is when you buy or you own the stock or the index, just like before, but now we're going to buy a put option. Rather than selling a call option, we're buying a put. It's a little bit like buying insurance, whereas the first strategy was like earning rent on the stock that you own. Now it's like we're buying insurance on the stock that we own. So we can get out when the price drops below a certain level. We don't have to worry about the price falling any further than that. So it acts like insurance essentially if the stock price drops. And this is great for hedging against downside risk. So looking now at the protective put payoff at expiration, what we're seeing here is that as we go long on the put, okay, so at this point we're starting at 100, let's say that's the price, and as the price of our stock starts to fall, we can get out at this lower price down here, the put strike price. Maybe it's 95. Now, at least what that means is that, well, we would have lost a lot more as the price went further, but we're not. We're getting out. So we can even think about buying it at the lower price and selling it at the higher price here at this point. So we have this profit. Now, if we were just long on this particular stock, obviously as the price goes up, our profit goes up infinitely, theoretically. But as the price goes down, again, it starts at 100, so anything under 100, you're losing value, you're losing profit. So if it loses from 100 to 80, that's 20%, we're down 20%. Now, if we just bought the actual put itself, it's the right to sell at a particular price. Now, by buying it, we're already spending money, so we're below zero here. But at least we could sell at a particular price. Let's say at 95 is the strike price. So if we saw that, oh, the market has fallen all the way down here to 90 or to 80, we can basically sell at 95, but we can buy at a lower level. So we could even, if we didn't own, if this was naked and we didn't own the stock or the index, then we could buy, let's say it was right now at 80, we could buy at 80, but because of our put, we could sell at, let's say, 95 and profit the difference, about 15, less the actual original price of the option that we paid, so less the price for the premium that we spent on. So this is the price of insurance. That's why it's negative in this case. Now, in this beginner strategy, we don't want to use naked options. We want to own this. So we own or buy the actual stock, and then we buy the insurance or the long put. So as a result, we're going to have to look at this red solid line, which is underneath. If we had nothing, again, we're not paying any insurance. So obviously we've paid insurance. We start to see, oh, we've limited our downside risk. This is the maximum downside risk. Doesn't matter how far down negative the price falls. We got out at 95. Sure, we had to pay for insurance, but that's the break even here, just a little bit lower than 95. As this price of the stock starts to fall even lower, we're not going to be making that loss. We got out before it further, and it can fall, and we can obviously exercise this up to the expiration date. So that's great for hedging against downside risk. All right, here's where I download my brain into yours. If you're serious about building real wealth, I put everything together in one full course, from $0 to multimillionaire. It's basically me handing you 20 years of hard-won financial knowledge, covering personal finance, investing, real estate, alternative assets, taxes, and financial freedom strategies. Links below, and you can use code Michael for a discount. Start wherever you're at. Just make sure that you're moving forward. That was the course plug. Now let's make you unstoppable with money. And the third and final beginner strategy for this video is what's known as the cash secured put. So this is where we're going to sell a put option while holding enough cash to buy the stock. So in this case, we either earn a premium from selling the put, or we could think about it like we might get the stock at a discount if the price falls far enough. So usually what you want to do with all these things and options is you want to be buying and selling on assets that you really do want to hold. Because here, again, we're going to be given the opportunity to acquire this particular stock. Let's say that the stock is trading at 100 and we've put it in for 95, like a 5% fall. Well, that's great. if the price doesn't fall, at least we've sold the option, we've earned some money without even owning a stock, right? Isn't that great? Imagine like making money without even owning the house. So a little bit like rental arbitrage in a sense. So you're making money without even owning it by just selling the actual option. Now, by having enough cash, it means we're no longer naked or covered. And that's why it's a beginner strategy. So again, we have enough cash there to buy. Let's say that the strike price was 95 and you have to have 100 for one contract. So we're basically looking at one contract. That means that we have to have $9,500 in our account at all times just to make sure that we can cover this. And a little bit extra for other fees. Now we can earn the premium, but of course, as the price starts to fall below the strike, we could be assigned that particular stock. So someone that has bought the put that we've sold or written, they're probably going to exercise that particular option when the current price falls significantly below the strike price. So we have an obligation when we're selling options, but we don't when we're buying options. So here we're selling, so we're obligated. If we are called upon, we must purchase the stock or the index from the other party at the strike price. So we need to have the money in our account so that it's covered. So we're earning a premium if the price doesn't fall, or we're getting into something cheaper. And that's great. Maybe you wanted to get into the index fund if it falls by 5%. And if it doesn't fall by 5%, you earn some money, which is great. And if it does, well, you also get into the stock or the index at a lower price. So this is great for buying stocks cheaper than market price. So looking at this graphically, say that the current price here is 100 and the put strike price that we've sold is at 95. So we have earned this gap here between 0 and, let's say in this case 2, if that was the premium. So we're earning this money from just selling or writing the put option. If the price doesn't fall by that much, if it stays the same, if it goes up, we still earn that rent, which is nice, even though we don't own the actual stock. Now, if the price of the stock starts to fall, well, we can get in, let's say at 95, right? We basically pay the price at 95. Now we basically take hold or ownership of the stocks. We're assigned these stocks. Of course, now we hold them, the price could go further. They could go further, and if it goes below a certain threshold, now we're in negative territory, but at least we got in low. So this wouldn't necessarily be good if you're trying to do this with, let's say, penny stocks, or let's call it S coins, right? S, a four-letter word starting with S, ending with T, those kind of coins, right? Or something like that in crypto, or something that we shouldn't really want to hold. So you only want to hold things. I like using options mostly on blue chips, but more importantly, I really just focus on index funds. So things like the Spider, like the 500 or the NASDAQ occasionally, but mostly I like the S&P 500 SPY options on the SPY, right? Because I do like to own the index fund, and it's great to basically make some extra return with the options. So again, this cash secured put is great if you think that the price is going to be around the same or go up a little bit, but also if you're thinking about getting in when the price drops a little bit lower. And this could be good for something where you think that the long-term value is good. Obviously, you know, if this is like a bad company, right, it could go all the way to 0. So it wouldn't be good to do options on something like that. But something like the index fund should probably go up over time. So it's always good to think about maybe selling a put option on an index fund that you're very positive about. So there you have it, folks. 3 beginner strategies for options trading that you might want to think about implementing today. And as always, like, comment, and if you like the information in this video and you want to hear more personal finance and investing topics, you're not already a subscriber, then please consider subscribing to the YouTube channel. It really helps the algorithm and I'd appreciate it greatly. So thank you so much, you guys, and I look forward to seeing you in another Investing Professor video.